Yeah, thank you so much, Foco, and thanks, Adora. And good afternoon, everyone. Good to meet you, and it's my pleasure to be walking you through this financial planning template. And I'm sure we'll all have exciting time just going through this as a walkthrough session. Now, the template has about four tabs. The first tab is the assumptions, and then the other four tabs. The assumption is where you make your input about revenue, input about cost, input about the growth rate and how you want to see the business grow, and even how you want to finance the the business or the financing mix or structures. And then the other four parts are non-editable. They are the income statement, the balance sheet, the cash flow statement, as well as the summary of your financial summary of the business. Uh, so I'll be walking you through briefly, and just before I do that, I'll just hold off for Foco to interpret. Then I'll ask for anybody who wants to give us a name. We can get it. I'll just put a typical entrepreneur's name. We'll get a business name, and then we'll get started. So what I've done in the past just few minutes is I've used my name as the entrepreneur's name. I've used a company that I own as well as the company name. And then I didn't bother by email. And we are also expected to then save these to TEF document, Connect document management system. So I'm going to the assumption now. And from the assumption, we can actually see how the assumption looks. You have your baseline. Baseline is the reference year or the reference data or information, whether revenue, whether sales, whether revenue or whether it's cost or even your every structure has a baseline. Every key component of the financial model has its baseline. The baseline is the starting point, and then you can then project using your growth rate for 10 years. So this is a 10 years financial plan, which is very important for every business. So we picked a business using the country of this business is Zambia, and the currency is kwacha. And then we want to pick a monoproduct. We are picking a product. Our product is we produce a kind of bag, a special bag for preventing for storing cowpeas. I don't know if most of us know there's this special bag for storing cowpeas. It was facilitated by the Bill and Melinda Gates Foundation. So that's the mono product we are producing. And company tax rate for Zambia, 30%. Bank interest rate is about 26.66%, and then inflation rate is 14%. However, the depreciation rates, all of these rates you see will be pre-populated. The company rate, you have to provide all of that. The company rate, because we are from different countries, the bank interest rate and inflation rate differs. But the appreciation or the depreciation rates for building up until installations and every other thing are given to you, and they are pre-populated. For our revenue projections, we are to give, this is a business that is starting. There's really no baseline in terms of what the current revenue growth is. So we just assume that on a year-on-year basis, our revenue, our volume, that's the volume of production. Since we are just starting, we are just entering the market, we can't say we'll grow by 50%, but we are projecting that for the first 2 years, this company will increase. So by 10%, the volume of our production will increase by 10%. By year 4, we would have increased our production of volume or sales volume rather, not production volume, to 15%. Between year 5 and year 6, or to year 7, or even year 8, will increase up to 20%. So we would have increased our sales volume because in the first year, 10%. So we get every 10 people that buy from us, one additional person comes. Then subsequently, from year 5, for every 10 people that buy from us, two additional people comes through referral or through whatever means. And then by year 10, we would have increased our sales volume by 1/4, which is 25%. And then for price, the first 2 years, we don't expect that our price will increase. And if the factors of production increase, we feel because we are just starting a business, we may not really increase like that so that we can gain market share, because year 1 and year 2, we are still trying to gain market share. So for that, we feel, okay, our price can remain the same. But from year 3, we increase marginally by 5%, then marginally from year 5 to 8%. And by year 10, we just increase our price, the price of this product by 10%. And then when it comes to the cost, I mean, there are different costs that is attributable to a production to the production of any goods or provision of services. Direct costs are those costs that directly affect the production. For instance, if you're sourcing for raw materials, the cost you incur in sourcing for your raw materials and all of those things, they are the direct costs that has to do with production. And we envisage that the direct cost to our production will be 5% and increase marginally up to 15% by year 10. And then the salaries, we also feel that salaries will increase 10% after year 1, and then probably due to inflationary rate, and then 20%, and then it will get to 30% by year 10, looking at the trend of inflation as well. Then our rent will increase for the first 2 years. It will increase to 10% marginally up until year 7, and then 20% by year 10. Then for our utilities, which is everything that has to do with electricity, internet, and all of those things, they will also increase on a year-on-year basis by 10% throughout the 10 years. We feel they will be stable and not increase significantly. Our marketing and advertisement cost, we also feel it to be 10% increment, because it's a small business we are starting. We believe there'll be a lot of referrals, and we may not need to spend so much dough on advertisement, and so no need to really increase it. Our administrative cost, which is also very important here, administrative costs will also increase. The cost of operations and every other thing will increase marginally by 5%, and then peak from year 6 at 10%. Our maintenance cost as well, almost the same trend as our 5% throughout, which is the cost of maintenance of our equipment and every other thing we need to maintain. Insurance on our goods, on the goods we buy, and every other thing, and even on the facility that we are using. We believe it will increase marginally by 5% on year-on-year basis, although typically this doesn't really move significantly. Likewise, our cost of transportation. Once we establish the baseline, we don't believe they will start increasing exponentially or out of control. Then subscription and licenses, the same thing. They won't. The regulatory authority will not just wake up one day and double the cost of licensing. No, or the subscriptions will make whatever subscriptions, it will increase on a marginal basis. Now, what I did was, in order for us not to waste our time, start populating. That's why I actually populated all of these things you saw. I just thought of, okay, let it be 10%, let it be 15%, it was just my own thinking. So that's why I pre-populated this. So let us now look at our startup costs. We are starting this business. So our building and civil works, we believe $50,000. That's our baseline. You can see that baseline is working now. So if we populate the baseline, so 50,000, 1, 2, 3, it automatically populates year 1 for us. Then look at furniture and fittings. Every other thing that you have within your chairs and all the fittings that you have in your office, the wardrobes, we said this will be cost us 200,000 kwacha. And this populates, you see, because recall, we have what we call depreciation here under these items. Can you see the depreciation? So what it does is that building is depreciated 5% on year basis, furniture 15%, equipment 25%, that's every 4 years, and then vehicles 20%, and then installations 10%. All of that is coming in here. All of them will start, but you will see the depreciation schedule down. When I get to that part, I will show you. Then we then said that equipment and machinery will cost us 500,000 kwashi. Vehicles, we can change the number, will cost us 200,000 kwachi. We can move the numbers around. I want to finish with what I've done. Then we can all work around how things change when we move some of these things significantly. And then installation, if you remove it, it automatically leaves here 100,000 as well. So those were the changes that the update that I made. And then the different adjustments were made here to show what is happening within the 10 years. You see, is it furniture and fittings that comes every 4 years or 25%? So the first 25% is in year 4, and then year 8, the next 25%. So it's looking year-on-year basis, 25%. Then by a full year of 4 years, you have 100%. So that's how the adjustment is made there. Then the other section that is very important is where you talk about your opening inventory. So you have different options on how you want your inventory to be. Your inventory are goods that you have that are ready to be sold. So we are saying that for this company, we'll have 2 months worth of direct inventory that can take care of all our direct costs, meaning we have enough goods that can take care of those costs that are associated with the production of those goods, the purchase of raw materials, the transportation of all of those things that has to do with the raw materials meant for that particular production. Those direct costs, we felt that 2 months worth of direct cost is what we want to hold as our inventory. It's not cast in stone. You can decide how many cost of inventory you want to, the worth of inventory in relation to your direct cost you want to hold. I've just chosen 2 months. We'll come and play with it later and see whether it affects our financials, income or balance sheet or not. Then initial working capital, we said our working capital is the amount you have at hand for your operating cost or managing your expenses. We said 3 months worth of operating cost. So our working capital, we will keep 3 months. So even if people don't buy anything within the first 3 months, we have enough cash at hand to run for 3 months before we start looking for money. So you see, we can change this opening inventory. You see, when we change it, 1 month became half of that. We can change it to 3 months. It becomes, you get what you see that those changes are happening. We can also change the initial working capital, and then our contingency can also change. So it just depends on us. There's no hard and fast rule about it. Apologies, I wanted to make this 10%. Okay, 2 months, 3 months. We can leave this at whatever percent it is. Okay, so let's just continue. The head count. Head count is the staff you want to have. So we are saying we are starting a new company. Our head count talks about staff. And because we cannot just know the benefits, we can't get to the details, the finite details of the cost. We said that the salary or benefit that our staff will have is 40%. So 40% of what the salary is. So everybody's benefit is 40% of their salary. And then, so for CEO and CEO or CFO, we said we'll have 2 people, the CEO and who also, then we have a CFO and a COO. so the CEO will act as the CEO and COO because, I mean, it's just a small business. There's no need to have all the three roles. And that's why you have to be careful as you think about your business. And then, so we'll remain two of them throughout for 10 years. No need to hire a very senior person. And then we said the base salary will be 10,000 kwacha, and then their benefits. And so what we did was you just put that two rows. That's the number of people. Then we sort of, so it's two. So the number of persons will always be two. So I just wanted to show you. So it's two here, two, two for the 10 years. Then for their salaries, we said it's 10,000 kwacha. And then once you put the 10,000 kwacha, you discover that the based on the way you wanted the salary to increase, year on year increase, it then adjusts by 10%, 10%, and then subsequently until year 10. So we do that for all of the roles. So we'll have the senior management, we have the business development, we say we'll have one business BM manager, no other person that will join, another associate will join by year 6. It's just thinking through how your business will work and how you want your business to play out. This is saying, look, I don't want too many people at the beginning, but as time goes on, I can add people. So that is what you do here. And the same thing that I did for the senior management, the same way you populate. Once you populate, it then adds up everything together. What it does is that it takes the total salary times the two people and then add the benefit, which is 40%, and gives you what the total salaries plus benefit for senior management will be on a year-on-year basis. The same thing for other staff. So when you're done with that, you can then, we said, for instance, this company may not have a marketing manager at the beginning because one of the senior management staff will also have as the marketing manager at the beginning, but over time, we then have a marketing manager. Same for IT. At the beginning, it's not really a techie company, but by year 4, an IT manager will come in and work with the company. Similar for other critical roles, they increase. There was no manager at the beginning, and then manager comes in at some point for back office staff. So that is how you think through the financial model, and then you fill it out. And as you fill it out, you begin to see how it plays out in the other worksheet. So once that is done, you then have the total salaries for each of those roles. Then that leads us to, so we've talked about the expenses, we've talked about we've come from the general, and we moved all the way from the general part of the assumptions to the growth rate. We moved to the startup cost. We moved to the head count. Now to the operating cost, which is very critical. Now the operating cost, like I said earlier, has your direct cost. Your direct costs are the costs that actually affect your production process. So your raw materials, the direct labors for regarding that raw material, the factory overheads, people that are the factory workers, and then the transportation. Everything makes up your direct cost. So for our direct costs, for example, we started with, I think, 100,000 kwashi. That's what we said our direct cost would be. And based on the increment we said year on year, that is why you see these changes. So you don't even need to change anything because this doesn't allow you to do anything. This is where you just put your baseline, every other thing we fill out. Likewise, our direct labor cost, if we remove it, you see everything cleans out, then we said it's 50,000 kwasha, and then the same thing. Factory overheads, I mean, these are just what I also put there. We said 15,000. Kwasha, the same thing. It then rolls out an increase on a year-on-year basis. And then transportation, we said 10,000. And that's how that would. Then our fixed costs, now fixed costs, your staff, those costs that will always, I mean, they are not variable. The cost of the first part are variable, but the fixed costs, the direct costs are variable costs. The fixed costs are those costs you will incur. Whether you are producing 50, you're producing 100, or whatever, it will always be a cost that you will bear. But you see, if the quantity of raw material you need to produce 50,000 rows of anything of that, of the bag, of 50,000 or 40,000 of the bags may not be the same thing in terms of raw materials. But if you're producing 100,000, it's not the same quantity you need when you're producing 50,000, which is just likewise the cost of direct labor and overheads. But this cost, whether you like it or not, you are also going to incur those costs. And you will incur them, they're there, and whether you even produce anything or not. If you stop production, you're not producing anything, or you have low production, those costs will continue to accrue. So we have salaries and wages. So we said based on the calculation we had there, salary and wages is 50,000. All the calculations that we did there is 50,000 kwasha, and then that one projected. Then our rent is 25,000. You know, the rent of the place where we are going to do the business. Utilities is 10,000 per annum. Marketing and advertisement 5,000. We just got this rate, but we can change them. You can just impute these, and the other ones will play out based on the growth rate you've set earlier. Okay. All right, great. Thanks for that. So revenue. So let's now get to revenue. Revenue is simply the quantity or the volume of the products times the cost of the service or the product. So our product, we said, okay, as a baseline, we have 500 of the bags that will be produced, and each bag costs 250 kwasha. And based on that, we then have our year-on-year expected production, which is starting from our baseline is 500, and then our incremental growth. Now, this is utilization, percentage of sales revenue realized. Now, this assumes that every year, all of our sales revenue are realized. There are instances where you make adjustment that you could only do 80% in year one, 80% in year two, because you are ramping up, and then maybe 90% in year three, 90% in year four, and then you continue to ramp up production, maybe by year, year maybe from year three, rather you start having your 100%. But what this does is what the percentages of sales revenue realized is taking into cognizance your production as well as how much of those things you produce that you will sell. So let's assume in year one, we only see as our baseline, we are sure we'll do 80%. And then as we proceed, we then increase to 90 and then ramp up production and then sales as well from year three, where we now have 100%. Then there's something here that also talks about seasonality. How does the seasonality of the product that the bag is used for affect our sales? Does it reduce in some part of the year? Does it reduce during the first half of the year, or does it increase at some point? Typically, when you adjust for seasonality, either goes up or come down depending on what is at play in the marketplace at that point. And then once that is done, your seasonality trend then comes in. And so that gives you what for your product, it gives you what the sales volume is likely to be on a year-on-year basis, based on the sales that you want to realize. So there are three products here. You know, we say we'll do a mono product. That's why you are seeing certain things that are not full, or that are certain sections that are not filled. Foko, you want to quickly take that? I'm trying to rush now. Great, thanks for that. So we are now going to a very critical part, which is what we call the working capital. Now, remember we talked about working capital earlier, and how much working capital do you want to keep as a percentage of your operating cost? So your working capital has three components. Your receivables, which is the goods you've sold for which you've delivered goods to customers, they've not paid you. You need to know how much cycle you want to allow, or what at times may be like a credit line to your customers. Here, I have felt that a 30-day cycle. So receivables are paid by. Receivables are what customers are owing you for the goods you've delivered or the services you provided. Then your payables, You see, working out, managing both your receivables and payables help you to manage, as well as your inventory, help you to manage your business very, very well. So we said 30 days, our customers must pay for this business. Within 30 days, we must pay. However, whoever we are owing, whoever we borrowed from, our payables is 60 days, meaning everything that directly affects our production, we won't pay until 60 days after those services are provided. But in our own bet, for those people that are owing us, they must pay us within 30 days. And we said, look, our inventory days, the inventory will hold 45, which is just over a month going forward, so that our inventory holding period is not just too long. So it means the number of days for which we intend to sell off whatever inventory we have. So if we produce within 45 days, we want to make sure they are disposed of. They will produce again within 45 days. Everything that we produce is totally sold out. So that's how we've done this. And based on the working capital, we then also, the next thing we want to talk about is our startup financing, how we want to finance the business. Now, there are four ways to finance your business. Either you provide the 100%, everything must start up to 100% anyway. 100% the capital, you are fully funding it, or you want to spread it, which is what we all typically do. In this case, I said, look, personal investment in this business is 1/10, 10%. A grant of 10% to equity, people that will invest in the business and then they will then own shares. It could be anybody who wants to have an investment in the business, 30%, and then debt, 50%, meaning half of our financing is coming from debt. Uh, uh, there's a reason for that. In some business, I mean, you just need to borrow money and then you run it. Some other ones you need that are capitally intensive. You need patient capital. Now, your equity, your grants, your personal investment, they are patient capital that you don't need to quickly pay back. But your debt is what you quickly need to pay back. For this kind of business, as you said, you can easily pay back your debt. But if it was a capitally intensive project or production that requires a lot of capital investment, you reduce your debt and make sure that your equity and grants are higher. I'm sure we all got that. So when we lay out our equity and debt, look, for example, when we fill them out, this is what they gave us based on the percentage here. For instance, if you change this to 20 and you change this to 0, you see that it will also change in the analysis as we go down. We'll get there where you see how the analysis how the analysis play out. So all of this will automatically compute themselves. Then the debt financing, what we said here is that we'll take the debt in year 1. We can also change it to year 2, but here we said, look, we are going to take the loan in year 1, and this is the amount of loan we'll need. We'll pay back in 5 years, and then the loan will end in year 6. These automatically compute themselves. Once you pick, you can change the year, but the others, all you need to do is just change the year you are picking the loan. Once you say, I'm picking loan in year 4, so it tells you when you have to pay back because you said repayment period is 5 years. You can also say repayment period is 2 years. Once you say 2 years, it also adjusts. So the only thing you can adjust here is the debt, the year loan will be collected, as well as the year or the duration with which you will pay back. Now, remember, there are three production lines, but we just picked only debt facility 1. We are not taking additional debt, just one debt, but you have opportunity to take three types of debt. So the schedules now, so all of the things we have put together, this is the debt schedule and the amortization of the debt. Year 1, the opening is 0, definitely. And then it's amortized. We pay back, look at it by year 5. We are paid back based on what we said there on the loan. Then the additional cost to that loan, our principal payment, the closing, all of the money we have to pay, total debt service. So year 1, we have to pay 244. So this just shows you your debt schedule and how you have to pay back your debt. Then even your working capital structure, look at the days of your receivables, the inventory, the days of payables, all of them translate to actual money. And then they tell you your net working capital, which is what cash, the money you have at hand to run your operations. These are calculations. Everything we have done, this place just shows us the details of everything. It shows us, like, for instance, the cost, the PPE, which is the property, the equipment, and the depreciation schedule of all our property and equipment. This just shows us on year-on-year basis what they are. And then you then see what the total will be based on the depreciation. This is the application of the depreciation. And then its closing shows what the total will be after depreciation is applied to whatever we started with. So we have the opening, the depreciation, and then the closing. No need to bore you with these details. We are not trying to make you a finance expert, but just for you to appreciate all what is happening here. At the end of the day, your net book value is for all your assets after depreciation is applied, what their net book value will be at the beginning of the, and then at the end. We started with, for instance, building was about, I think, 50,000. At the end of 10 years, it's just 25,000 that is left. So this just shows you how everything will depreciate over time. Thank you. Okay, great. So all what we have done, let's go and check them out in the income statement. So if you look at the income statement, our revenue, this is our revenue on year-on-year basis. You can't edit it. You see, there's no way I can edit this. It's not editable. But everything I've done in the assumption is already playing out. My revenue, which is volume, the volume of goods sold times the price, is already showing me what the revenue would be, and is increasing on year-on-year basis based on the growth that we've set for ourselves. And then, so your total revenue, which is your cost times your volume times price, minus the direct cost, which is the cost of direct cost incurred with production, raw materials, direct labor and factory, and all of those things, as well as inbound logistics or transport. When you take the direct cost away from that, the template will calculate it itself. It gives us the gross profit. Then all the expenses, from salaries to all the operating expenses, all salaries to depreciation, it then takes that away and then gives us our operating profit. And then it takes away our interest expense on loan. Remember, we said we would take a loan. And then the profit before tax based on the tax rate we provided. And then it then gives us what our profit after tax or our net profit will be. For this organization, it's making about 700 kwasha in year one. So the organization is doing well. And then the profitability is increasing up until year 10, meaning this financial model is very robust and very robust for a very good business, meaning this business, everybody will want to be a part of this business because it shows that this business person, this entrepreneur knows his business, and this business is likely to be profitable. And then when you also look at our assets, from our current assets, which are the liquid assets, both cash at hand, as well as cash equivalent, savings and everything, up to the non-asset, not current assets, everything adds together, as well as all our liabilities, our borrowings, the account payable, everything have to balance out both the asset side and the liability balanced. It's very clear, it balances out. We don't need to bother ourselves. It will balance itself out. Then the cash, which is very important. Based on everything we did, we have a net operating cash. It shows that on year-on-year basis, this business will have enough cash to even invest, enough cash to put in other things. So this business has shown very good. It's a cash cow. It has a lot of cash. So financing activities, whether through equity injection, we said we are just taking equity in year one. We are taking loan in year one, paying back by year 5, which is clear here. We don't want any loan because we have cash. This company has shown that it's able to generate enough cash for its business. So everything at the end of the day showed that we will have enough cash, even on year basis, as we continue with this business. Finally, we now have our summary, how the entire business, more like a dashboard, how the financial summary and the 10-year P&L So for our annual P&L waterfall, it shows a very good company that is maintaining the cost and making some very good net income. Whether you look at it, you can check this on a year-on-year basis and see how the financial is changing. There will be adjustment showing us how uh, how the company is making money and the revenue. This just shows the cost is really low. We're able to keep our costs low while keeping the revenue very, very high. So it's a profitable business. Then this just shows us 10-year P&L, how the chart from revenue expenses as well as the net income is, so you can see that net income increased as well as the revenue also increased over the 10-year period. Though costs increased, but because the others are higher, we realize that the company is going to stay afloat. This is the kind of business everybody wants to run. And even for our cash flow, this is a company that is a cash cow with a lot of cash at hand to do a lot of things. So thank you. That is the presentation. So looking forward to your questions. So,
thank you.
All right, great. So we open to questions. Thanks, everyone. So over to you, Adora.
Thank you so much. Thank you so much, Asako. I've been seeing comments from the participants. This session is so engaging. You made the teachings, you made the Excel so easy. You made the explanation so easy. So there are some few questions on here. One question is from Nego Links is asking, do one need an accountant to assist me on the financial plan?
In reality, it's good for you to understand your business. You can have somebody guide you, but more often than not, it's good for you to understand your business as well. Even if you engage an accountant, yes, you can go ahead, get an accountant to help you work on the finances of your business, but it's also good for you to understand your business finances, because irrespective of whatever you sell, how grandeur your business is, the continuous existence of that business depends on the financials. And so having an idea and understanding of your financials help you even when you go out marketing, when you go out selling. So it's good, a very good person. If you have two entrepreneurs, one doesn't have a clue as to how the business finance works, and the other one has a clue, there'll be two different people in terms of the kind of success they will make in their business. Yes, you can engage somebody, but it's good for you to understand how the Naira and Kobo, the Kwasha of your business works.
Thank you so much, Popo and Osato. So the second question is, how does this financial plan apply to a business running an IT business?
Fantastic question. For an IT business, right, this is also very applicable. I mean, whether you're running, irrespective of the business you're running, you would definitely need to employ staff. You would definitely need to have a startup cost. You definitely need to project your growth rate. So instead of bag of whatever you're cowpea, you can put your IT services or your IT product that you are providing. Maybe you're providing IT services, you're developing a software. So you can put whatever software. So instead there, also the tax rates, all of those things are applicable. Then your revenue projection, you can put the rates based on what you want to do. But what would then happen is when you get to the head count, here where you have, look at the place where you have your IT. You're going to have a developer. So you can fill out, you're going to have developers. How many developers are you going to have? That is just the staffing. So the staffing will change. And every other thing, your operating cost. I mean, yeah, we talk about raw materials here, but for an IT person, a software developer, there are things you definitely need, the resources you need as part of developing this may probably apply to, this has to be a little bit general, but you discover that most of the elements are still very critical. So you're going to produce a particular software application that is going to be deployed buy an entity. You need to buy, there are certain things you will buy in developing that particular software. Those things can go into your direct labor costs. You may not have factory overheads here, but it could be other costs that relates to whatever you want. You have, you definitely have licensing fees. You definitely have cost of everything you require to actually develop that application. Even if you're using an open source, you're going to probably pay some money for that open source. If it's free, you can put zero there as zero cost. But if it is something you pay for, you put the amount, whatever amount is. Your fixed costs, whether irrespective of what you're doing, your fixed costs are also going to come in because your fixed costs are critical in operating your business. So those fixed costs are going to come. The salaries, your rent, they will definitely come in. So this is very applicable. It's just some elements that you need to tweak. So this is a flexible financial model that can be tweaked to align to whatever industry you fit into. Yep. Yeah, the reality is this, right? If there are areas that doesn't apply, I'm just looking for the commission area. When they say commission, I'm trying to recall the area that speaks to commission. Adora, hello?
You can look on marketing. Marketing can
Yeah,
be part
that's
of
where
it.
I'm going to. I'm trying to look for marketing. I was around that area. I'm just trying to recall. Uh, on the, is this the area? I think so, right?
Yes, I think so.
Yeah.
Mm.
Okay. The reality is this: if your business doesn't require you to solve, probably there's no marketing involved. But I doubt if there's any business that doesn't have some element of marketing in one way or the other. What this does is just help you capture all the critical elements that are critical in your business. It gives you the gamut of arrays of areas that could be applicable. But if you think it's not so important, you can leave it out. But what may happen is that you may not be capturing all of the cost elements that builds into your business. You may actually be, you may actually be shortchanging yourself at the end of the day. So your profit reflection may not be the actual thing. So removing commission that has to do with marketing or the cost of marketing. Yes, but you're doing marketing anyway. Why not just attribute a cost to that so that all the cost elements, because as your company gets bigger, you discover that marketing may become a very critical part of your business, depending on the area or industry you're focusing on. So it makes sense to actually acknowledge it. But if you think it's not so necessary, you can leave it out. There is really no hard and fast rule about it. But if it is an industry that relies a lot on a lot of persuasion, going out to meet people, to drive sales, to begin to convert those sales into customer or wins or sales volume, marketing is very heavy. So if your industry is heavily reliant on it, indicate it. If it's not heavily reliant, you can reduce it significantly. But it would be good to also show that there's some element of marketing in what you're doing.
All right, thank you so much, Foko. Thank you, Osato. So I think we've come to the end of the questions and the end of the information session. Thank you so much, Osato. If you look at the comments on YouTube, it's been overwhelming with thank you. The session has been so insightful. The session has been so engaging. You broke it down granular, like it was very basic for a non-financial expert. So thank you once again, Osato. And for the submission of the business plan, we will send you a link soon. We'll let you know when you start the submission of the business plan. So look out for your emails. So look out for your emails. By the end of May, basically, or precisely, you should be getting an update as to when and how you will submit the business plan and financials. So start putting it together. We have sent the links in all of our communications. You see the business plan and the financial template in the various languages, English, Portuguese, French, and Arabic. So start populating or start developing your business plan and your financials. I think this session has broken down how you should create your financial plan granularly, and the business plan session we had last week as well. So we hope to see you all in the next masterclass session. Thank you once again, Foucault and Osato, and have a good day, everyone.
Bye, everyone.